Met today and took some crucial decisions. First, the exposure of mutual funds to corporate bonds, that has been cut. And second, dissenting shareholders have been allowed to exit the company but do so with riders. Sajeet and Naveen join us now with the details. Naveen, to you first. There are concerns over the health of corporate debt, and the move by SEBI seems to be to try and safeguard the interests of investors.
Yeah, in fact, the biggest takeaway from today's SEBI board meet that was held in Mumbai was that the setting up of limits for investment by mutual funds in particular company as well as group and sector as a whole. So this move by the regulator is basically to safeguard the interest of the investors, especially after what happened in the Amtech Auto and the JP Morgan fiasco. So now look at the limit of exposure in single entity that the SEBI has fixed for mutual funds is that to invest is at 10% of NAV of the fund, which can be extended to 12% post the approval of the trustee. On the other hand, the exposure limit to a single sector is reduced from the current 30% of NAV to 25%. Meanwhile, the mutual funds limit at a group level to invest in a group for debt schemes now stands at 20% of NAV, which again can be extended to 25% of the NAV after the trustee approval. Other than this, the SEBI has also decided to merge credit exposure limits for single issuer of money market instruments and non-money market instruments at the scheme level. Other than this, the issuance and listing of green bonds will be governed by SEBI, and the issuer of green bond will have to make incremental disclosures to the regulator. Back to you.
Thanks, Naveen, for joining us with us. That's the decision taken by the SEBI board today on limiting the mutual funds exposure in corporate debt. Now let's go across to Sajeet. Sajeet, dissenting shareholders now allowed to exit companies. Obviously, they have to be riders. What are these conditions?
That's right. SEBI has come out with regulation to align itself with the Companies Act 2013, which allows for exit of shareholders in case of dissent in some of the cases like change in object clause or mergers and acquisition. In the current case, what SEBI has come out with is that in case of the company or plans to change its object clause, the promoters and shareholders will have to provide for exit of dissenting shareholders. The clause, the riders being that at least 10% of the shareholders should be dissenting against the change in object clause, and the company should have diverted or plans to divert more than 25% of the proceeds to another object as compared to what it plans plan to do as part of the prospectus. The date for the relevant date for this would be the board meeting when the board will decide to change the object clause, and the pricing would be based on the SEBI's takeover code. Remember, some of the companies don't have promoters, and in that case the companies which don't have identified promoters or shareholders, prominent shareholders, will be exempt from this, including government companies will also be exempted from these. So this is some of the, this is basically alignment of regulations with the Companies Act 2013, and this was perhaps the last board meeting where Mr. UK Sinha would be chairing as the board chairman, unless the government goes ahead and gives a extension to him.
No, that looks unlikely, Sajeet, at least as of now. But thanks very much, Naveen and Sajeet, for joining us and taking us through the decisions taken by the market regulator at its board meeting today. That's now